Welcome to the Deep Dive. Today we're digging into a fresh stack of research on the Bank of Montreal BMO and their Q4 2025 earnings call.
Yeah, it dropped before the market opened on December 4th. And our mission today is really to separate the headline numbers from what's happening underneath.
Because the headlines looked great. Management called it a record year.
They did, but the market didn't seem to agree. The reaction was very cool.
Exactly. That's the contradiction we want to get into. You've got, an 8% adjusted earnings beat, record net income for the year at C, $9.2 billion.
And the stock falls 1.5% on the day, on heavy volume, too.
So what's going on? What caused that immediate sell-off? I think we need to unpack their strategy in the U.S., their capital targets, and the real big one, the anxiety around credit quality.
That's it. That tension between great results and a negative reaction, that's where you find the real story. The market is pricing in a future risk.
Okay, so let's start with the results snapshot, because on paper, this was a fantastic quarter.
It really was. Adjusted EPS hit $3.28, which, absolutely crushed the consensus estimate of around $3.03.
And revenue?
Adjusted revenue came in at $9.34 billion. That's about a 4% beat over the street.
But the number that I think long-term investors are watching is the profitability, the return on equity.
Right, the adjusted ROE, that's how efficiently the bank is using shareholder money. And it hit 11.8% in Q4.
Which is a huge jump.
A massive jump of 440 basis points from last year.
Yeah.
It's a really powerful signal that their efficiency push is starting to work.
And you can see that in their operating leverage, right? Revenue growing faster than costs.
For sure. They hit positive operating leverage of 4% for the year. And the efficiency ratio, that dropped 230 basis points down to 56.3%. All good signs.
Okay, what about the credit and capital headlines? Because they also look solid at first glance.
Very solid. Provisions for credit losses, the PCLs, were way down.
How far?
About 50% lower year over year. They dropped from C$1.52 billion to just C$755 million. And their key capital ratio, the CET1, stayed strong at 13.3%.
So this brings us back to the big question. If earnings were great, credit looked better, and capital was strong, why did investors give it the cold shoulder?
I think it's a mix of things. Either the market just doesn't believe that PCL number is sustainable, or the bar was just set so high for Canadian banks that even good news wasn't good enough.
Which flows right into the strategic changes they're making, doesn't it? This is all about BMO's big reengineering plan.
It is. And the engine driving all of this is what they call the ROE imperative, that relentless focus on getting profitability higher.
They hit a full-year ROE of 11.3%, which is up 150 basis points. That's not bad.
Not at all. And they're sticking to their guns on that long-term goal, reaffirming the 15% medium-term ROE target.
And they think they can hit it in the early part of that 3 to 5 year window. That feels very ambitious.
It's ambitious, for sure, assuming the macro environment plays along. But look at how they're deploying capital. That shows confidence.
Over $8 billion returned to shareholders this year.
Right, through buybacks and dividends. And they just bumped the quarterly dividend by another 4 cents to see $1.67 a share. A 5% hike. You don't do that if you're worried about earnings.
So this brings us to what I think is the most interesting part of their strategy right now, their capital stance.
Their CET1 ratio.
Yeah, they're actively trying to bring it down from 13.3% toward a target of 12.5%. Now, help our listeners understand this. Why is lowering a key safety ratio seen as a good thing?
That's a great question, because that 12.5% target is lower than some of their big Canadian rivals.
So they're breaking ranks.
They literally said they're comfortable breaking ranks. They're choosing capital efficiency over capital hoarding. Their argument is, our risk systems are top-notch. Our U.S. bank is a fortress with its own high capital ratio, so we don't need all this extra padding at the main company level.
So holding on to that extra capital is just dead money. They'd rather put it to work.
Exactly. Put it to work, generating higher returns for shareholders. But you can see why it makes the market a bit nervous, right? In an uncertain economy, running a bit leaner takes a ton of confidence.
Supreme confidence. They're basically betting that their risk models are better than everyone else's.
And that confidence in their capital flows directly into the next piece of the puzzle, reshaping their U.S. footprint.
The big capital recycling exercise, moving money out of low-return areas into high-growth ones.
Right. So on one side, they're getting out of some areas, selling 138 branches across 11 states.
That's about U.S. $5.7 billion in deposits, right?
Correct. They're trimming what they see as non-strategic scale, getting rid of legacy infrastructure that's just not pulling its weight on the ROE front.
Okay, but hang on. They're selling 138 branches. only to then announce they're opening 150 new branches over the next 5 years. Is that just replacing old with new at a huge cost?
It seems like it, but it's really a structural retilt. The new branches are all about densifying in specific high-growth markets. Think California.
So it's about focus.
Exactly. Trading broad, thin coverage for a deep, focused presence where they can sell higher margin products like wealth management.
Which brings us to the Burgundy Asset Management deal.
Yes. That integration brings in about, $27 billion in assets under management. It's a massive push into the high net worth space.
And why is that so strategic right now?
Because wealth management is capital light and fee rich. It's revenue that doesn't tie up your balance sheet, which is exactly what you need to hit that ambitious 15% ROE goal. It juices their fee income and makes them less reliant on lending.
And speaking of moving beyond just lending, they're really pitching themselves as more of a platform company now.
The whole digital-first AI-powered strategy. And this is a key part of how they're getting that efficiency ratio down.
They mentioned some internal tools, right? Lumi and Rover?
Yeah, Gen AI digital assistants for their frontline employees. And they said they have an over 80% active user base.
Okay, but what does an 80% adoption rate on an internal AI tool actually mean in dollars and cents?
It means higher productivity. It means an employee can use Rover to pull up a complex policy document in seconds instead of minutes. It cuts down call times. It cuts down processing times. It's a structural efficiency gain that helps keep costs flat while revenue grows.
And what about on the customer side?
They're launching new payment APIs for real-time corporate payments, expanding their CDR offerings on U.S. stocks.
Yeah.
But the really interesting move, I think, is the partnership with Walmart Canada.
The Delivery Pass partnership.
Yeah, that's a pure customer acquisition play. It targets younger, value-focused customers who might not walk into a traditional bank branch. It's a low-cost funnel to get new clients they can cross-sell to later. Very modern.
So the whole strategy seems pretty cohesive. Manage capital aggressively, optimize the U.S. surgically, and use tech to cut costs. But we have to talk about the elephant in the room.
Credit. The thing that clearly spooked the market.
Right. Even though PCLs were down, management was pretty upfront about where the stress is building.
Very honest. They pointed to two main areas. First, the lower end of their Canadian credit card portfolio.
And second,
broader consumer pressure. They're expecting Canadian unemployment to stay high, maybe even above 7%, through the middle of 2026.
Wow. High unemployment and high household debt. That's a toxic mix for unsecured consumer loans.
It is, and that's why BMO is actively shifting away from that segment. They talked about focusing on premium card products, like their new co-brand with Porter Airlines.
Targeting customers with higher incomes and better credit scores, a strategic hedge.
Exactly. So what's their overall economic outlook? They're expecting a softer Canadian economy in the first half of 2026. No surprise there.
But their commercial clients are more optimistic.
Cautiously optimistic was the phrase. They said their commercial loan pipelines are strong, but loan growth will probably be delayed until Q2 or Q3 of 2026. Delayed, importantly, not canceled.
And to deal with this, they're managing costs proactively. There's a big restructuring charge coming.
There is a $225 million charge in the first quarter of 2026 for workforce optimization.
That's a big number to swallow in one quarter.
It is, but it's an investment.
Yeah.
That charge is expected to generate $250 million in annualized savings, with half of that hitting the books in 2026. They're taking a short-term hit for long-term efficiency.
Okay, so let's pull this all together. Record results, a clear strategy, but the stock sells off. The big fear is just that credit losses are going to be higher for longer.
That's the consensus worry. The buy side sees the consumer stress in the unemployment forecast, and they're worried that even those cost savings won't be enough to offset a big spike in future PCLs. That credit overhang is capping the upside for all the banks right now.
You could really feel that tension during the Q&A, especially around M&A.
Absolutely. The CEO was asked directly if they would issue stock for a big U.S. deal or sacrifice their U.S. ROE target just to get bigger.
And the answer?
A very firm, very definitive no. He was clear that any M&A has to accelerate the ROE journey, not slow it down. The focus is organic growth and small, smart acquisitions like Burgundy.
Which is a critical assurance for investors worried about a big, value-destroying deal.
It is, and it's part of what gives BMO a bit of a unique flavor right now. They've also stepped back from the Net Zero Banking Alliance and are expanding in commodities. They're charting their own course.
So the path forward seems pretty clear. They need to close the branch sale, integrate Burgundy, and get those commercial loans growing by mid-2026.
And do all of that while keeping credit losses in check. That's the real test.
Which brings us to our favorite segment. This is not financial advice. We're putting on our investment committee hats to pitch a trade based on everything we've just discussed.
And this one is all about the credit bifurcation that BMO's own management flagged. The growing split between the stressed low-end consumer and the more resilient premium segments.
It's the trade idea, a credit bifurcation pair trade.
Right. So the first leg, the action, is to go short a basket of Canadian financial companies that are heavily exposed to that lower-end mass consumer unsecured debt market.
You're basically taking management's warning about credit card stress and betting it'll hit their less diversified competitors even harder.
Exactly. Then the second leg, the hedge long, is you go long BMO, probably using their U.S.-listed CDRs, to bet specifically on their fee-driven growth engines.
So you're not just betting on BMO as a whole, but on the success of their wealth division, capital markets, the Burgundy deal, and that premium credit card push.
That's the thesis. You're capitalizing on BMO's proactive pivot away from the stressed consumer, right as that economic pressure really starts to bite. You capture the upside from their strategic shift while hedging the broader risk in the Canadian consumer space.
A very compelling pitch. So to summarize our deep dive, BMO put up a really strong financial year. They're making real progress toward that 15% ROE goal.
But the market is still on edge. It's waiting for proof that rising credit concerns and a soft Canadian economy won't derail the whole thing and force them to rethink those aggressive capital targets.
And before we go, we should give a quick nod to their outgoing CFO, Tayfun Tuzun. This was his last quarterly call after 5 years.
He definitely oversaw a period of huge strategic change for the bank. We'll be watching their Investor Day in March 2026 for the next chapter.
And we will leave you with a final thought to chew on, building on that capital debate. Is BMO's aggressive 12.5% CET1 target a sign of capital mismanagement in uncertain times, or is it a signal of supreme confidence in their risk models and future earnings power? We'll find out.